Welcome to The Explainer. Today we're digging into Beyond Meat, a company and a stock that's become a serious battleground on Wall Street. It's a wild story.
So let's get right to it. Why is this stock so incredibly volatile? Why is it one of the most debated names out there? Well, it's not just one thing. It's this perfect storm, really, of financial trouble, some pretty dramatic corporate moves, and just the raw mechanics of the market. And when we say volatile, we are not kidding. Just take a look at these numbers from one single day of trading. The stock went from $1.14 all the way up to $1.48. Think about that. That's a nearly 30% swing in just a few hours. This tells you right away this thing isn't trading on what the company's actually doing. It's all about sentiment and pure momentum.
All right, so to really get why it's so crazy, we've got to pop the hood and look at the company's financials. And spoiler alert, it's a real pressure cooker situation under there.
First up, the debt. And we're talking a lot of debt. Before a huge recent shakeup, Beyond Meat was sitting on over $1 billion in what are called convertible notes. Basically, it's a kind of short-term debt. And for a company this size, that is a crushing weight.
And this right here, this is the heart of the problem. This is what's fueling the whole crisis. The company isn't making money. It's just burning through cash like crazy. Look at that, almost $60 million gone in just the first half of 2025. That's what we call a serious cash burn problem.
So what does that actually mean for the company? Well, you have to think about something called the cash runway. It's like a runway for a plane. It's how much time you have before you run out of road, or in this case, money. And this is where it gets really serious. The hard truth was, when you did the math, cash on hand versus how fast they were spending it, they had about 2 quarters left. Just 6 months. That's it. That is a terrifyingly short window to either turn the entire business around or, find someone to give you a whole lot more money.
So, with that clock ticking down, what did they do? Well, this leads us to the company's big, dramatic move. They were backed into a corner, and they did something drastic to survive. And this one decision, it changed everything for the company and for its investors.
It all happened fast. In the fall of 2025, they pulled off this super quick debt exchange. The whole point was to kick the can down the road on their debt problems, to buy themselves a little more breathing room.
But here's the catch, and it's a big one. Look at the trade-off they had to make. Sure, they got rid of that huge $1.15 billion debt problem hanging over their heads. But the price they paid, wow. They printed over 300 million new shares of stock. That massively watered down the value for anyone already holding shares. And on top of that, they took on new debt, over $200 million worth, at a higher interest rate. So yeah, they bought themselves some time, but it came at a huge, huge cost.
Okay, so they dodged the immediate bullet with the debt, but that didn't magically fix everything else. Not even close. In fact, a bunch of other problems were piling up, creating this giant wall of worry for the company's future.
You've basically got this trio of major risks. First, and this is a big red flag, they had to delay their financial report because of what they called a material weakness in their internal controls. That's the kind of thing that really spooks investors. Second, the whole market they're in, plant-based meat in the US, it's actually getting smaller. Not a great sign. And third, the competition is just brutal. You've got Impossible Foods, store brands, and hey, just regular cheaper meat.
And as if all that wasn't enough, there's this other, more technical risk. The Nasdaq has rules. If your stock closes below $1 for 30 days in a row, you get a warning that you might get kicked off the exchange. To fix that, companies often do a reverse stock split, which, let's just say, historically, that's not something that makes investors happy and usually just pushes the stock down even more.
So you put all of this together, the financial problems, the new shares watering everything down, the shrinking market, and what you get is a perfect storm. It's created this epic battleground stock, where you have the bears, the people betting it'll fail, clashing head-on with the hopeful bulls.
And the scale of this fight is just mind-blowing. At one point, the short interest, that's basically the number of people betting the stock will go down, was over 100% of all the available shares. Think about that. That's more shares being bet against than actually exist to trade freely. And that setup is a ticking time bomb.
And that's what sets the stage for something called a short squeeze. Here's how it works. If even a little bit of good news comes out, all those people who bet against the stock, they panic. They have to rush to buy shares to cut their losses. But because everyone is trying to buy at the same time, the price just explodes upwards. And that's where you get those wild 30% swings in a single day.
So what do you do with a stock like this? You've got terrible fundamentals on one side, but this potentially explosive setup on the other. How do you even approach it? Well, it really boils down to which camp you're in. There are two totally different ways to look at it.
When you break it down, there are really 3 possible paths for this stock in the short term. You've got about a 25% chance of the bull case. Some good news hits, the shorts get squeezed, and the stock pops up to $2, maybe even $3. But there's an equal 25% chance of the bear case. More bad news, and it drops below $1. The most likely outcome, though, with a 50% probability, is that it just kind of chops around where it is now, with these big, crazy swings.
Now, if you're a short-term trader, someone who likes this kind of action, there's a potential game plan. The idea is you might look to buy shares when it gets close to that key $1 mark. Then you set your profit targets, ready to sell if you get one of those squeezes. But, and this is absolutely key, you have to have a strict stop loss, say below 95 cents, because if it breaks down, you need to get out fast.
But if you're a long-term investor, the advice is completely different, like night and day. This is not a buy and hope situation. The smart money says you stay on the sidelines, you wait for proof. We're talking at least 2 straight quarters where the company shows real fundamental improvement.
And this really sums it all up, doesn't it? There are 2 ways to see Beyond Meat today. For a trader, it's a toy. It's a high volatility machine you can use to play these big swings. For an investor, though, it's a show-me story. It's about waiting patiently for proof that the actual business, the cash burn, the profits, is truly on the right track. And that could take a while.
So that leaves us with the big question. Is this the start of an epic comeback story, or is it the final warning shot for a company that's just about out of time? Honestly, the answer to that is going to come down to one thing. Can Beyond Meat prove that its actual business is as tough as its crazy volatile stock?